This video covers Learning Objective 2, Part 4, the LIFO inventory cost method, in Chapter 6, Inventory and Cost of Goods Sold. So let's get started. Now we're going to talk about the last in, last out inventory cost method, or LIFO. LIFO is the opposite of FIFO. The cost of the last units purchased go to the cost of goods sold, while the cost of the most recent units purchased are assumed to be sold first. The oldest costs are in ending inventory. Let's go through an example of using LIFO. We will use the same set of data that we used in earlier videos on the other inventory cost methods. In May, Shade Company had a beginning inventory of 30 pairs of sunglasses that cost $10 each for a total cost of $300, 30 times $10. During the month, Shade purchased another 20 pairs at a cost of $15 each for a total cost of $300, 20 times 15. At the end of the month, Shade had 10 pairs of sunglasses left in ending inventory, having sold 40 pairs during the month. Calculate Shade's cost of ending inventory and its cost of goods sold for May. I am going to highlight the critical pieces of information in that data set now. First, we see that beginning inventory consisted of 30 pairs of sunglasses that cost $10 each for a total cost of $300. Next, we see that the company purchased another 20 pairs of sunglasses at a cost of $15 each for a total cost of $300. At the end of the month, the company had 10 pairs of sunglasses left in ending inventory. We don't know the cost of those sunglasses in ending inventory, so we are going to have to apply LIFO principles to get that cost. And finally, the company sold 40 pairs of sunglasses during the month. Again, we do not know the cost of those sunglasses sold, and that is why we are applying the LIFO method. We are going to start by summarizing the data in a table format. Beginning inventory was $300, which came from multiplying the 30 units by the $10 each. Purchases were $300, which came from 20 units purchased at $15 each. The total cost of goods available, therefore, was $600, which was the beginning inventory plus the purchases. The total units available for sale were 50 units, which came from the 30 units in beginning inventory plus 20 units of purchases. We will be calculating ending inventory and cost of goods sold. Let's first start by calculating ending inventory using the LIFO method. Ending inventory is from the oldest units. See the beginning inventory line above. So its cost is 10 units times $10 or $100. Next, cost of goods sold starts with the most recent units. 40 units were sold, so all 20 of the units in purchases were sold, plus another 20 from beginning inventory to get to the 40 sold total. To calculate cost of goods sold, you can also take cost of goods sold available minus ending inventory, or $600 minus 100 equals $500. The second way is easier if you have the total cost of goods available. Just subtract the ending inventory cost from cost of goods sold available to get cost of goods sold. Remember that beginning inventory plus purchases has to equal ending inventory plus cost of goods sold. And that concludes this LIFO example. Let's compare the FIFO and LIFO inventory methods from a couple different standpoints. 1. Measuring cost of goods sold. How well does each method match inventory expense, cost of goods sold, against revenue? LIFO results in the most realistic net income figure because LIFO assigns the most recent inventory cost to expense. In contrast, FIFO matches old inventory costs against revenue, a poor measure of expense. FIFO income is therefore less realistic than LIFO income. 2. Measuring ending inventory. Which method reports the most up-to-date inventory cost on the balance sheet? FIFO. LIFO can value inventory at very old costs because LIFO leaves the oldest costs in ending inventory. A word of caution, LIFO is not allowed if using International Financial Reporting Standards, or IFRS. Now we have a few knowledge check questions coming up to test your understanding of this material. After I read the question, pause the video and try to answer it. Once you restart the video, I will be walking through the answer for the question. Let's go. The first question reads, when costs are increasing, the cost assigned to ending inventory using LIFO is lower than when using FIFO. Is this statement true or false? The answer is true. The second question reads, Rohrer Company has the following data for June. Beginning inventory, 10 units at $12 each equals $120. Purchases in June, 5 units at $15 each, $75. Ending inventory is 7 units, and 8 units were sold during June. What is the cost of ending inventory using the last in, last out LIFO method? The choices are $84, $96, $105, or $111. The answer is $84. Ending inventory is from the oldest units since the most recent units are the first ones sold. We can take all 7 units from beginning inventory. 7 units at $12 is therefore the $84 ending inventory cost using LIFO. The third question reads, Rohrer Company has the following data for June. Beginning inventory, 10 units at $12 each equals $120. Purchases in June, 5 units at $15 each equals $75. Ending inventory is 7 units, and 8 units were sold during June. What is the cost of goods sold using the last in, last out LIFO method? The choices are $84, $96, $105, or $111. The answer is $111. Cost of goods sold is from the most recent units since the last units in are the first ones sold. There were 5 units purchased at $15 each. We need to take the remaining 3 units sold, 8 sold less the 5 from purchases from beginning inventory at $12 each for a cost of $111, or 5 units times $15 plus 3 units times $12. That concludes our review of the LIFO inventory cost method. Thanks for watching.